Welcome to Investment Solutions by EDHEC Risk Institute. We're going to talk about hedging. Hedging is an extremely powerful form of risk management, extremely useful in the context of the design of investment solutions. So we are going first to introduce the concept of a risk-free asset. What exactly do we mean by risk-free? And hedging is actually all about eliminating risk. And if you're successful at hedging, then you should be holding a risk-free asset, almost by definition. Then we are going to talk about liability hedging portfolios and goal hedging portfolios, which are the incarnation of the risk-free asset in the concept of an investment solution, either for institutions or for individuals. And finally, we are going to talk about funding ratio, making the claim that what matters is not asset value per se, but asset relative to the value of the liabilities or of the goals that the investor has to finance. Okay, well, first of all, let us recognize that diversification alone cannot help manage systematic risk. By definition, you can only diversify away what is not systematic. You can diversify away specific risks. Not only you can do it, but you should do it because asset pricing theory tells us that these specific risks are unrewarded and there's no reason why you should be rationally holding them. But once you've been able, through diversification, to eliminate, diversify away specific risk, there's nothing that you can do about systematic risk using diversification. That's precisely when hedging is needed. So hedging is needed to help reduce exposure with respect to systematic risk factors that impact portfolio of our investors. So in a way, if you think about diversification, it's all about how to take risk in a well-rewarded manner, how to extract risk premia in the most efficient way. So diversification is how to be efficient at taking risk. Hedging is how to be efficient at not taking risk. So if and when risk-taking is not desired for the investor, then we need hedging. So let's think about the definition of a risk-free investment strategy. What exactly do we mean by something that is risk-free? Well, a risk-free investment strategy is an investment strategy that leaves the investor with no uncertainty about the final payoff. What we learn from this definition is what we mean by the risk-free asset is not a concept that's defined in isolation of the investor and of the goals of the investor. In other words, there are as many risk-free assets as there are investors, and even for each investor, for a given investor, as there are different goals. Well, let's take a few examples. Let's assume we're looking at an investor that has a time horizon of 10 years. In this case, investing in cash is extremely risky. Even though cash looks like it's a safe investment from a short-term perspective, it's actually a very risky investment from a long-term perspective. There's lots of uncertainty in the rollover of this short-term cash investment. In particular, the concern might be that interest rates keep going down, and therefore the value of your assets is not growing extremely fast. So what is the risk-free asset for an investor that has a 10-year time horizon? So assume an investor has a goal of $100 worth of consumption in 10 years from now. Well, the risk-free asset is a 10-year pure discount bond. That's an asset that will have a payoff exactly equal to the $100 that the investor needs in 10 years from now. Now, we just talked about an investor who cares about consumption. Well, if you care about consumption, you actually do not need $100. You need $100 plus inflation. So in other words, what matters is the purchasing power of wealth. Well, in this case, the risk-free asset is not a nominal pure discount bond. It is an inflation-linked pure discount bond with a 10-year maturity date. Well, if we extend these concepts and if we generalize them to the a general situation where we're looking at an investor facing liabilities. That would be the case of a pension fund, for example, or an insurance company. These are institutional investors and they face liabilities. Well, that's not very different from individual investors who face goals, consumption goals, retirement goals, whatever. Well, in this case, we have to define what is the goal and what is the risk-free asset, with respect to this particular goal. So as an example, if the goal is generating replacement income that allows retirees to face consumption needs in retirement, well, in this case, the risk-free asset is not a pure discount bond. It's a ladder bond portfolio. This ladder bond portfolio is a portfolio of pure discount bond, potentially inflation-linked, with face value and maturity date matching replacement income needs in retirement. So the accepted terminology when we talk about these safe assets for our institutional or individual clients is LHP, stands for liability hedging portfolios. That's the safe asset for an institutional investor. Or GHP, which stands for goal hedging portfolio, well, that's the safe asset for an individual investor. Now, once we've been able to define the concept of a safe asset, the next step is to think about investors' welfare or investor happiness, not in terms of how wealthy they are, but in terms of how well funded they are, which is a very different concept. So in other words, we're going to introduce the funding ratio. The funding ratio is simply defined as the ratio of assets divided by liabilities. Now, we have to understand that if asset goes up, this is not necessarily good news. Because if liability value goes up by more than the assets, your funding ratio actually decreases. And that's extremely bad news. So what matters is not asset value per se, it's asset value expressed in terms of the numeraire that makes sense, which is the value of the liabilities. So the real question is, what is your purchasing power in terms of your liability needs or your goals that you need to finance? Now, the concept of the funding ratio shows extremely clearly how effective hedging can be. So if you think about cash, now if you look at the monthly returns of a simple strategy that invests in cash, well, cash is this T-bill investment, that's the red curve on this graph. It looks like extremely flat and extremely smooth. There's not much going on. If you contrast that to the goal hedging portfolio, in this case, the goal hedging portfolio is a replicating portfolio for replacement income in retirement. It's a long-term, long-duration bond ladder portfolio. Well, that long-term bond portfolio looks extremely risky, and it actually is extremely volatile, as we can see from this picture. As interest rates go up and down, the value of that portfolio goes down and up in a pretty significant way. So from this perspective, it looks like cash is safe, and this goal hedging portfolio is extremely risky. Well, but of course, this is the wrong perspective. That's the wrong way of looking at the problem. The better way at looking at the problem is to look at the dynamics of the funding ratio, which is what matters for the investor. From the investor standpoint, the funding ratio is what they care about. So if you want to get hedging, if you want to achieve perfect hedging, what you'd like to see is a funding ratio that stays constant. Well, as you can see, now the situation is reversed. With a true safe asset, which is the goal hedging portfolio, the blue one, then the funding ratio stays flat and constant. Now, when investing in cash with this rollover of T-bill investment, which looked safe from an asset-only perspective, well, in terms of funding ratio, it is extremely volatile. Okay, so the key conclusion is hedging is all about neutralizing the impact of risk factors on portfolios that are dedicated to protecting investor goals. Well, this is an invitation for you to take a closer look at all the material on our website dedicated to the implementation and usefulness and benefits of hedging in the context of investment solutions. Thank you for your attention.